So guys, today we will be looking at investment appraisal technique number 2, which is called net present value, right? So before I start off today's lesson, right, normally guys, in the physical class there is a note what I'll be giving it and asking you to make it in your or take it down in your writing book. So guys, I have 3 pages of notes over here. Please pause the video whenever that's possible and please copy down all these notes because it's going to be extremely important, right? For any student who is having an idea to follow anything after A levels in the accounting field, what you are going to study today will be extremely important and critical even for your advanced level paper. This technique, which is called net present value, will be tested every year, right? So listen carefully, right? Number one, right, net present value. Now in the last video we looked at payback period. So what does payback period explain? How long does it take to cover the cost of an investment or to cover the cost of a project? How many years or how many months it's going to take me, right? Net present value is going to consider time value of money, or in other terms present value of money. Now I would have spoken about present value of money in my last video, and some of you may have not understood actually what is this meaning of present value, right? Here is a basic example, right? Let's say someone is promising you 100,000 by the end of December 2021, right? Now most people will be okay, right? We're going to get 100,000 by the end of next year, right? Most people will be satisfied. But what you all don't see is that you're going to get 100,000 at the end of next year. You should actually see that 100,000, what is it worth in today's term, that is on the 1st of April 2020. How much is it worth? That should be your main focus. So present value does that. Now let's say for example, right, we are supposed to get 100,000 at the end of December 2021. Now our objective should be, we are not concerned about December 2021 value. We want how much is that in today's terms. So today's terms means we are going to get 100,000 next year on 1st of April 2020. How much is that actually worth? So what you do, in case you want to bring a future cash flow to today's term, you multiply something called discounting factor. So let's say for an example it's 0.9. What is discounting factor? We'll come back to that a little bit later in this video, right? So once you multiply over here, our answer is now going to be, right, 90,000. So this is what this technique actually does. So net present value means it takes the cash flows what you are going to get in the project, but the problem is that these cash flows are going to happen into the future. These cash flows, what is the actual worth of it, what is the value of it in today's term, is what net present value actually does. It considers time value of money, or it considers present value of cash flow. So how does it consider? It simply takes a cash flow, multiply with something called discounting factor, and that answer what you get is what you call present value of money, right? Now guys, in payback period, you know how to make a decision. Let's take 2 projects were given to your hand. Whichever project gives you the shortest payback, you select that. In net present value, you will be selecting it this way, right? Let's take for an example, 2 projects are given for you. You do all the relevant calculations, right? Project 1, last answer is positive. Project 2, last answer is negative. So that you always go and select or invest in the positive project. Now in example 2, we have 2 projects. Our last answers are both negative. In that case, you are not going to invest in any of the projects, right? Example 3 guys given over here. Project 1's last answer is also positive. Project 2's last answer is also positive. In that case, you have to always go and invest in the project that is going to give you better answer. So remember, under net present value, how are we going to make a decision? It's very simple. You do all your relevant calculations, get your last answer. If the last answer is positive, yes, you are going to invest in that project. If the last answer is negative, no, you are going to reject the project. So it all depends on whether the answer is positive or negative, right? Now guys, over here I mentioned something called a discounting factor. Now what is a discounting factor, right? Right, now remember, for advanced level syllabus, a student does not need to go this deep, but for you to understand this lesson properly, I have to explain what is a discounting factor, right? So guys, here I have given for you certain points here. You have to read that one, right? Thing is this. Now, generally when you go to invest in a project, either the company will have money or they will go and take it from outside, right? Let's take for an example, the company doesn't have money, so now it has to raise finance or it has to raise capital. So one form of collecting capital is by issuing shares, but you have to understand, when you issue shares it does not come free, there is a cost, you have to pay them dividends. So let's take for an example, when I take a ordinary shareholder, I have to pay for him 4% dividends. That money is not enough, so maybe I will go and take a bank loan. Bank loan is also not given free, I have to pay an interest to that. So let's take for an example 6%. So if I take ordinary shares, my cost is 4%. If I take a bank loan, my cost is 6%. The average value of those two is what you call a discounting factor. So a discounting factor in simple terms is called cost of capital. That means when you are going to invest in a project, when you borrow money from outside, you have to pay them a small amount, a cost. So the average of all those costs taken together is what you call a discounting factor. The good thing is, in your exam they will always tell you this is the discounting factor. Now in most exam questions they are going to use 10%. So remember, in any A level paper that you do, the discounting factor or the cost of capital will always be given to your hand. So you don't have to worry about this, but just understand discounting factor means what? The cost of capital. When you take money from outside to invest in projects, the average value of the amount that you are going to pay to them is what you call a discounting factor, right? Now guys, in the last video I said you that I'm skipping question number 1 to 8 and I'll cover that everything in a simple video, right? This is where I'm covering all that, right? Okay, now remember, how are we going to tackle a given exam question, right? Like I said you, in all the papers so far, they have always asked you to calculate net present value. So number one, you pick up this question, you read the requirement, they might ask you to prepare payback, or they might even ask you to prepare something called net present value, the technique what we are discussing now. Number one, before you start on the technique, there is an important thing. First, you have to always prepare a cash flow table. So remember, when your examiner is asking you to prepare payback period, or if he is asking you to prepare net present value, step number one, you must always prepare a cash flow table. Now cash flow table means not the cash flows what you prepared under IAS 7 or LKAS 7. It's not that cash flow table, a very straightforward table which is going to show money coming in and money going out, right? Okay. Now guys, these are some of the things what you have to note when you prepare a cash flow table, right? Number one, you read your transaction and decide whether cash is coming in or cash is going out. Any cash coming in, you mark it as positive. Any cash going out, you mark it as negative. Not only you should decide whether it's a cash inflow or an outflow, you should also decide to which year is it relevant for, right? Let's take for an example, there is a transaction. You have to decide, is it for year 1, is it for year 2, or is it for the last year? You have to always decide those two things first. Number one, decide from the transaction, is it a cash inflow or an outflow? And also please decide to which year is this transaction relevant to, right? Now guys, in most exam papers, these are some transactions which are repeatedly tested, right? So when you prepare a cash flow table, you'll always start off with something called year 0. So what do you mean by year 0? The year which you are investing, or the year in which you go and buy a machine, something like that. Okay, so remember, under year 0, the following things will always be relevant, right? Number one, purchase price of an asset. So remember, when you find to buy this new machine, it's going to cost us 1 million. So that 1 million should always come under year 0. So remember, when you buy a machine, money goes out of the business. So therefore the answer is negative, right? Second one, residual value or scrap value of the old machine, right? Now it's like this. Let's assume the question is about buying a new machine. So when you buy a new machine, buying happens in year 0, you go and mark that as negative. Now when you buy the new machine, you don't need to keep the old machine, you can sell that. So the selling also will happen in year 0. So when you sell the asset, money comes into the business, so therefore the answer is positive, right? C, working capital investment is given as negative, right? Now guys, remember, what do you mean by working capital, right? Let's take for an example, I went and bought a machine. So when I buy a machine, I should invest in things like stock, invest in things like trade receivable, trade creditors, and all of those. So this is also an investment to make the machine work or run the machine. So therefore, what you should do is take it as negative. So remember, it's a working capital investment. So because it's an investment, cash goes out of the business. So therefore, it's minus in year zero. Right, and also guys, if you find any installation fees, professional fees, or surveyor's fee, make sure you go and mark that under year zero as a negative figure. Right, and then in each question you may have things like operating expenses, sales, purchases, that you should decide with the given question to you how much and for which year. But these are some factors which are common to each and every paper, so I want you to memorize these transactions which are common. Right, and then guys, the following will be relevant for the last year. Scrap value of the machine. Now generally when you buy a machine, maybe you can use the 4 or 5 years. So after the 4th year or after the 5th year, maybe you're going to sell the machine. So therefore when you sell the machine, selling always happens in the last year. So you go and mark that in the final year as a positive, because money comes in. Right, and then guys, one more thing. Right, working capital recovery. Right, now remember, this should always be a plus. Right, okay. Right, now let's take for an example, I'm doing a given question. In that question they are telling me working capital investment is 100,000. So what I do, I go and mark 100,000 in the very first year or in the year zero as a negative figure. The same 100,000 what I am investing in year zero, this entire thing will be recovered in the final year as well. Okay, now you might be thinking, why are we recovering the entire thing? Right, the reason is very specific. You buy a specific machine. Let's take for an example, you buy a photocopy machine. Working capital for the photocopy machine will be buying A4 papers. So you are investing in A4 papers just because you buy the photocopy machine. So yes, when you invest, money goes out. Now in the last year of the project, you are selling your photocopy machine. So if you are selling the photocopy machine, the A4 papers what you invested is now not needed because your machine is now not with you. So therefore, whatever the paper, that money that you invested, you will sell the papers again and get back your money. That's why whatever the working capital you're investing at year zero is for this relevant asset. In the final year, if you're selling the asset, there is no point of keeping this working capital. So therefore, this entire working capital is recovered, but not now. It's recovered when you're selling the machine. That is, it will be recovered in the last year. So always remember, whether a question says or not, working capital is always recovered. Again, I'll repeat that sentence. Whether a question says or not, working capital is always recovered. Why is working capital recovered? Working capital is done for the specific machine. If the machine is not there, there is no point of having working capital. That's why working capital will always be recovered at the end of the year. So please memorize these transactions what I have given to you on the screen. Okay, that will make your work easier. Right, advantage and disadvantage of net present value I will explain to you after we do a question. If not, you will not understand what I'm going to explain over there. Right, so guys, we'll start off with what you can say. So I want you to take your tute. Right, go to question number 13. Right, we will do a very straightforward transaction. Right, look at this one. Janaka had decided to buy a machine. His interest is concentrated on two machines with the brand name X and Y, and the following money estimates are given. Right, so remember, you have two machines. For both the machines, you are supposed to calculate NPV. So what do you mean by NPV? Net present value. Right, so let's do for X. Now remember, like I said in the video a few moments ago, if the question is asking about NPV, the first thing what you should be doing is preparing a cash flow table. After that only you can start any calculations. Right, so I start off with, right now, number one, there are 5 years to this question, but you have to always add another 1 year to it. Okay, year zero. Right, So in the cash flow table, what are we going to do? We are going to decide whether money comes in or goes out, and we are going to mark in the relevant year, right? Number one, for machine X, the initial cost is 200,000. So remember, when you buy a machine, money goes out of the business, right? So you mark over here, description, purchase price. So always remember, purchasing of a new asset, like in the note that you have in the writing book, will always happen in year 0, right? So you mark over there negative 200,000. Done. Expected lifetime is 5 years, so that's why we are running the project for 5 years. And the expected scrap value is 10,000. So what they are trying to say over there, you can use this for 5 years. After using this for 5 years, you can sell the machine for 10,000. But remember, you can sell the machine when? After 5 years. So therefore, this should come to the 5th year, 10,000. Right, now remember, when you sell the machine, money comes into the business. So I will leave it as positive, and I'll mark over there scrap value. Okay, right. So remember, 200,000 you're buying the machine. Buying normally happens in year 0. This you will get 10,000, but not now, after 5 years. So that's why I'm marking this in the 5th year, right? Expected net operating cash flow, right? Now remember, cash flow, they have given all as positive, so meaning all are cash inflows, right? So I'll mark over here cash inflow, add the word net to it, right? Now remember, it starts from 1. Okay, so during the first year I earn 80,000, right? During my next year I earn 70, right? Okay, right, now guys, remember, what I have picked now over here is a very basic question. In your advanced level exams also, you will have to prepare a similar table this way, but you will have more adjustments into this. Okay, so in your paper directly they won't give net cash flow. There might be things like sales, purchases, expenses, and things like that. Okay, right, 60,000, and finally we are going to get 55,000. Right, so guys, with that I have considered for machine X all the answers. Right now what you should do is totally tough. So this is what you call your total cash flow, right? So during year 0 my answer is negative 200,000. First year again 80,000. Second year it's 70,000. Third year 65,000. Fourth year 60,000, right? And final year 65,000, right? Okay, so that's how guys you prepare a cash flow table. Draw up appropriate format, decide whether money comes in or goes out, and always decide for which year is it relevant. Then your work is easy, right? Now guys, once you finish off your cash flow table, you have to now prepare a table called, right, so like we were saying over here, right? So guys, once you finish off your cash flow table, then you have to prepare another one table called present value calculation, right? So number 1, again the question is going for 5 years, so I set up the table, right? Cash flow, what are you going to mark here? Now in your cash flow table, all these last answers or total cash flow should now be copied to this table, right? So I'll copy all these to this table. So guys, that's why the cash flow table is important in any question, because for you to do the NPV, you need cash flow. From where you are going to get these answers? From your cash flow table. So that's why you have to prepare this table for you to have all these answers. Right. Then guys, DCF, from where did I get this? This one. Discounting factor, they have given 18%, and also they have given you the answer. So like I said at the start of the video, always remember, in your examination, discounting factor, they will always tell how much percent. Sometimes it can be 5, 10, 20, it can change. And they will definitely give you these decimal numbers as well, right? Now guys, remember they have given you from 1. Always remember in year 0 the answer is 1. So if you want, you can make a note in your writing book. Understand that it doesn't matter whether it's 5%, 10%, 20%, 25%. The discounting factor for year 0 will always be 1. That is because year 0 means what is happening now. So now if you are investing 200,000, obviously the value today is also 200,000. That's why at year 0 the answer is always 1, because year 0 means what is happening now or in the current year. Right. Right, then guys, you simply copy all these factors given to you, right? 0.8, 0.7, 0.6, 0.5 and 0.4. Right. Okay, now guys, how you are going to get this last answer? It's like this. Always remember, cash flow, you have to multiply it by your discounting factor. Right, so remember how to get present value. Take your cash flow, multiply it by the discounting factor and mark your answer over here. Right, so 200,000 into 1, that will be negative 200,000. Right, and then guys, 800,000 into 0.8, you will get your answer. Right, so guys, please use your cal and get all your answers over there. Right, so that will be 64,000 over here. Right, so take 70,000 and multiply it by 0.7, that will then be 49,000. Right, 65,000 into 0.6 will be 39,000. So 60,000 into 0.5 will be 30,000, and 65,000 into 0.4 will now be 26,000. Right, then guys, how to get the present value, the last part of the calculation. Right, so guys, what I want you to do is 5 years you are having positive answers, add all these together and subtract from 200,000, you will find your answer. Right, so therefore guys, our answer is 8,000. Right, now guys, remember, because you have a calculator, right, don't go to mix up the sign, because in this technique we decide whether we are going to invest or not based on the sign, that is whether our answer is positive or negative. So from the previous batches, when I thought, students did make mistakes because they started to change the signs and take. So now this year, because you have a calculator, don't make a mistake. First you mark minus whatever the value that you are investing, take all these numbers as it is and get your final answer. So remember, in this project our last answer is now going to be positive 8,000. Okay, right, so guys, the same way only we are now going to do our other machine or project Y as well. Right, so we can quickly finish off that one over there. Right, so machines wise, initial investment is 230,000. Right, so let's go and mark that one. Initial investment, or you can mark it as purchase price even, no problem. So that's negative 230,000. Always remember, initial investment or purchase price will always take at year 0. Okay, right, this machine also we can use for 5 years. After using for 5 years, the scrap value we are expecting is 15,000. That means we can sell for 15,000. Right, so you mark there. Right, scrap value 15,000, but remember, you can sell it for 15,000 after 5 years. So therefore this should always come to the last year of your project. So when you sell, money comes in, that's why it's positive. Right, and then guys, same like machine X, they have given for so much cash inflows. Right, so let's copy that one. Net cash inflow. Right, so we have 100,000, 70,000 and 50,000 respectively. Right, so just copy it as it is. 100,000, 70,000 50,000. Right, and then guys, same as the last one, we're done with the question. Start totaling it up to get your net cash flow. Right, so you total it up vertically, negative 230,000. Right. So guys, once the cash flow table is complete, we have to now complete the present value table. I have put down the years. Cash flow, from where we are going to get this answer, those are the answers, your final answers from the cash flow table, right? So start copying all these final answers inside the cash flow table. Right, so minus 230,000, sorry. Right, then guys, discounting factors will remain the same. So remember, like I explained, if it's year 0, the answer should always be 1, right? And then you simply copy whatever the discounting factors that the question has presented to you, right? So it's 0 0.8, 0 0.7, 0 0.6, 0 0.5 and 0 0.4. Right, so guys, how to get present value? Right, so same like the last one, you take your cash flow, multiply it by the discounting factor to get your present value. So 230,000 into 1, negative 230,000. Right, so this should now be 80,000, should be 49,000, 30,000, 25,000, and finally 65,000 into 0 0.4 will now be 26,000. Right, now guys, add all your inflows and subtract with this 230,000. Right, so that is now going to be negative 20,000. Right, so guys, let me check that again one more time. Minus 230 plus 80 plus 49 plus 30 plus 25 plus 26, yeah, negative 20,000. Right, right, so guys, the addition is very straightforward. Machine X, my present value is 8,000. Right, so let me mark this one. Right, whereas machines Y, my last answer is now going to be minus 20,000. So I have two projects. First project is a positive, second project is a negative. So if we are going to make a decision, like the question is asking us, okay, right, you have to invest in machine X because NPV is positive. Right, so remember, two machines were given to me. When I calculated the present values, first one was a positive and second one was a negative. So as per theory, you have to always invest in a project where the NPV is positive. So therefore here the obvious answer is we have to invest this in machine X. Right, then guys, final part, calculating or discussing about the advantages and disadvantages. Right, so advantage number 1, this is the most superior technique. So remember, in your A-level syllabus you have 3 things: payback, accounting rate of return, and also net present value. So remember, from the three techniques given to you, this is the most superior technique in your syllabus. This also considers risk through the discounting factor. Right, now remember, in a net present value, how do you get your answers? You take your cash flow and multiply this by the discounting factor. The moment someone multiplies this by a discounting factor, you are already considering something called a risk. That is because, right, this is actually out of your syllabus, but let me give you a brief understanding. When you go to calculate cost of capital, you need to take in various things into consideration. Things like industry risk, asset beta, um, also things like the cost of the loan, cost of debentures, and all of those things. So when all of those things are put together only, we are getting this answer of 18%. So when all those factors are put together, market risk or the industry risk is already considered. So therefore, inside the NPV answer, our risk has already been taken into consideration. Right, next advantage, it considers cash flow. So guys, same like payback period, investment net present value also considers cash flow. So therefore, it cannot be manipulated. So that's an advantage. Right, it considers time value of money. Now remember, this was a disadvantage in payback period, because payback period, we just took the cash as it is. We never saw time value of money. But in present value calculation, it's not like that. We take the cash flow, multiply it by discounting factor to understand how much is it worth in today's terms. So therefore, that is an advantage. Right. And last advantage, guys, it considers the entire project. Now, if you can remember in payback, example 2 or question number 10, what we did. Project 1, after covering the cost, you never considered what happens after that. But in present value calculation, it's not like that. If the project is going to last for 5 years, all 5 years were considered. But in payback period, it's not like that. If the cost was covered in 3 years, you're not seeing 4 and 5. You're just ignoring that and only seeing the first 3, which was a disadvantage. But in NPV, all these 5 years are considered. Right, and then guys, finally disadvantages. It's time consuming. Even now you would have understood that getting the calculation done takes a lot of time and human effort, and getting the factors what is needed is not easy. Now I was telling you a few terms earlier, things like industry risk, asset beta. Taking all that in practical terms is not easy. So therefore, getting these factors to do the present value calculation is a tough task. Right, so guys, with that one we have covered what is investment, what is net present value, advantage, disadvantages, factors to be considered, and also we've done a calculation. Right, so please make sure you go through this video carefully. Make sure that you ask any doubts which is to be cleared. Right, and we'll be having a session this week where we are discussing all the past papers. Right.